Welcome to the Overberg Asset Management Weekly Market Review. In this episode, Nick Downing shares with us the highlights of the markets, both globally and in South Africa. If you find this video helpful, please press the like button and do subscribe to see our upcoming market reviews.
Good day and welcome. I am Nick from the Overberg Greater office. We are glad that you can join us. Today, we are looking at the developments globally, if there have been any changes and how they might influence the markets. What is it that has rattled the markets? It's mainly a pivot, quite a strong pivot by the central banks, not just the Federal Reserve, but also the ECB, saying that they're not excluding the possibility of a rate hike as early as this year. The BOE, quite a few members of the policy committee voted for a 50 basis point rate hike, let alone a 25. And the Federal Reserve, of course, not just ending its quantitative easing program, but now talking about quantitative tightening. And the market has taken this actually in its stride. Of course, underneath it all, underneath those broader indices, there has been some fairly ugly performance. Some of the very highly valued stocks have dropped a lot of them by 40, 50%. But companies are buying those shares, particularly real quality ones. But overall, the market correction has been very tempered, and the reason for that, and this is a theme that's going to come through with the different research snippets that I give to you just now. The main reason is that we are not at all likely to enter a recession. So yes, there will be some volatility because of quantitative tightening as the air gets let out of the very highly valued sectors of the market. But because we're not entering a recession, it means earnings growth will continue at a fairly healthy clip. And it's very, very rare for there to be a bear market in equities unless there's a recession. All right, so let's move to some of the research. The first bit is really about quantitative easing, quantitative tightening, the effect of liquidity on the markets, and how long we can expect this quantitative tightening to go on for. So we've got very good research from Cross-Border Capital. As usual, they specialize in this subject, and also from our friends T.S. Lombard. T.S. Lombard, what we can agree on is quantitative tightening presents a major threat to equity markets, and yields are going higher. The central bank environment is becoming much less friendly. However, they do need to stress the following point. Even though central bank liquidity will be withdrawing from the market, to a large extent, private sector credit is capable of filling that gap. And this is a point that's going to be brought up by other analysts. They cite the long-term resilience of the household sector, strong balance sheets, and the credit expansion opportunity in the private sector. Cross-border capital, the Fed is sounding ever more hawkish about both policy rates and balance sheet shrinkage. History suggests that a major liquidity slump lies ahead. And they look at the bond yield, not just the bond yield, but also the bond yield curve. So that's looking at short rates, medium rates, long rates. And there's a curve that can either go upwards or downwards, but there's also a shape to the curve. So sometimes it's concave, sometimes it's convex, which means the belly of the curve has got higher yields. They don't like the fact that at the moment there's convexity, curve flattening, and high volatility. And those are all bad omens, confirming the next upcoming liquidity slump They talk about a phase of turbulence. The necessity for more defensive equity positioning will be important. The short answer is that Wall Street is being sacrificed to the god of lower inflation. Although we firmly believe in the low secular inflation camp, it remains a fact that US liquidity cannot explode higher by 30 to 40% as it just has, without there being a serious inflationary spillover. There's an additional point that the pass-through of these shocks has become longer lasting since 2020, meaning that a jump in inflation now seems set to last around 26 months rather than the more typical 8 months. However, looking longer term, and this is a very important point picked up again by T.S. Lombard and alluded to by a lot of macroeconomists and analysts, despite the likelihood of greater headwinds for stocks in 2022 and inevitably more volatility, we still figure that buy the dip is a decent long-term investment strategy. With interest rates low for secular reasons, for instance, demographics, technology, globalization, and so forth, equity valuations will remain high, and with debt burdens large and ever rising, central banks will be forced to maintain future balance sheet expansion. So they're saying, and T.S. Lombard would agree with this, that this quantitative tightening is not going to last very long, and it's not going to be nearly as bad as the markets are currently predicting. And just to quote here from T.S. Lombard, in the end, QT, quantitative tightening, has a limited shelf life. The fact is, demographics are forcing the budget deficit up. Zero yields are keeping money in assets that are too risky, and the Fed has no choice but to try and keep us all afloat by buying enough debt at a low real yield. So interesting subject, interesting take. Moving on now to asset allocation, which you'll find the themes here are volatility, but continued increase and expansion in the markets. A little bit, first of all, from MRB on inflation. They are definitely inflation hawks, unlike cross-border capital. They say inflation in the developed market economies is increasingly problematic. It is well above central bank expectations. It has lasted longer than they forecasted and is not limited to supply chain driven constraints, and furthermore has started to infect service sector prices and labor markets, and has become a political liability for governments. However, at the same time, global economic recovery seems poised to solidify in the months ahead, underpinned by fading of the Omicron variant, buoyant household savings, a strong job market, and flush corporations anxious to expand their businesses. And we're looking at a couple of graphs. So there's a graph here looking at the MRB modeled cyclical momentum indicator. So before the recent sell-off, which began almost on the 1st of January, the cyclical momentum indicator was very overbought. It was above 2 positive standard deviations. So it's now dropped all the way back to the mean, and that's a long-term mean stretching back 22 years. So it's no longer overbought. Admittedly, it's not oversold, but it's at fair value. Similarly, the risk appetite indicator has dropped all the way back from 1 positive standard deviation to a negative territory, minus 0.5. So the market has moved from being overly optimistic to becoming pessimistic, and that is always a good opportunity to get back into investments, particularly for long-term investors. In other words, value is returning to the market. A little bit of caution here, the Federal Reserve owns approximately, wait for it, 38% of outstanding longer-term Treasury bonds. The Federal Reserve faces a daunting challenge, therefore, of shrinking its balance sheets, bringing down inflation, and sustaining a healthy economy. The risk of a policy mistake is rising and significant. The recent equity sell-off is likely to be repeated several times over the balance of the year as monetary policy accommodation unwinds. But most likely after each sell-off will be a buying opportunity. If it's good enough for Pershing Square, it's good enough for Overberg Asset Management. And now here's a bit of a slightly academic piece. I think it's very interesting. It's incredibly logical, and I think a very powerful argument for why markets continue rising in the absence of a recession. So bear with me. The forecast of stock prices at the end of 2022 is really a forecast of a forecast. The US benchmark on December the 31st, 2022 will not be a function of corporate earnings at the end of this year. Rather, it will be a function of a consensus forecast of corporate earnings for 2023 and beyond. While the Wall Street, or the Street, puts a lot of emphasis on calendar year forecasts, market pricing tends to be based on rolling 12-month forward earnings expectations. An often overlooked characteristic of 12-month forward earnings is that they generally have a natural upward bias during an economic expansion. Analysts rarely predict a decline in 12-month forward earnings for the market as a whole unless and until there are clear signs that a recession is imminent. A couple of common functions or wisdoms of the markets, I think tenets maybe is the word to use. So coming up, here's a quote from MRB: narrow credit spreads reinforce that the recent sell-off in equity markets has been mostly driven by an unwinding of frothy valuations rather than escalating concerns about the economic outlook and corporate fundamentals. Our preferred plays include select non-US equities, small caps over large caps, value stocks over growth stocks, and financials. And this is the wisdom that tends to hold over the decades. Typically, changes in market leadership occur during corrections. The oil price, $1 million question, very relevant for inflation, very relevant for consumer expenditure, very relevant for company profit margins. According to Capital Economics, their base case remains that oil prices will fall back significantly. Our view is that the probability of an actual conflict between the US-backed forces and Russia remains low.